Is it time to buy the Apple dip? It is more than 3% down just today, down 9% over the last few months. And when we compare it to other companies in the Mag 7, it is the second worst performing, down 9% versus Tesla, which is down negative 22%. So let's find out, is this a company? Is it undervalued? We're going to take a look at a lot of information. We're also going to discuss some breaking news that we have with Apple being fined 1.8 billion by the EU. As always, we'll discuss their growth, look at their top line revenue, bottom line net income. We're also going to incorporate their latest earnings report where we can see a lot of slowdown in the growth of this company, and we'll look towards the future to see what they can come up with to rejuvenate their numbers. We'll also look at the health of the company on the balance sheet side, total cash versus total debt. We'll also run the company through the insider screening, looking at insider buys as well as insider sales. And we want to have a brief look at the institutions, if this is a company they are still adding in the more recent quarter and over the last few months. And don't forget, whilst we will look at their dividend safety, we'll also run through some of their financial metrics to see whether or not we see any operational efficiencies or slowdowns overall. And finally, one of the most important things, we'll look at the valuation of Apple, we'll get to the intrinsic value, we'll look at their acceptable buy price using that investor margin of safety, as well as what Wall Street are forecasting. On top of the valuation, specifically for the discounted cash flow model, we're going to look at 3 different growth rates for the future, low, medium, and high, to just gather the information needed to see whether or not, based on these targets that we have, Apple can continue to grow like it has done over the last 5 to 10 years. So let's start off just with recapping their historical performance. Now, they are down 9% over the last year to date. However, over the last 12 months, they are up 24%. Over the last 10 years, up a strong 848%. Even though that doesn't include those dividends reinvested. And we can see they are now trading in the midpoint of the 52-week range. The yield forward looking is 0.53% and a forward P of 27.41. Now, before we look at the latest news, we'll also very quickly look at how they performed. Looking over the last 12 months, we can see that Apple are the second worst performing, again similar to year to date. They are just doing better than Tesla, which is down negative 5%. However, when we expand this to the last 5 years, what we can see is that Apple is in the midpoint of the performers in the Mag 7, up 314%, which is very strong for any 5-year period. But always remember that past performance is never an indicator of future performance. So let's take a look at this latest article that did just get released today around Apple being fined 1.8 billion by the EU for breaking their streaming rules, which has also had some effect that we do see on that share price drop today. So going through this article, what we can see, they have been fined 1.8 billion euros. The reason for this, well, we can see the competition commissioner said that Apple abused their dominant position in the market for a decade. And this was essentially coming from Spotify, who were very unhappy about the restriction of Apple's 30% free, which they did cite being illegal under EU antitrust rules. Therefore, we can see this has come down on Apple, and we will discuss whether or not this will have any effect on their numbers over the forthcoming years. So something just to consider. Now, while we do look at the numbers, what we can see is they have been growing over the last 5 years when we look on a more short-term approach. As always, whilst we look for 3 to 7% growth year on year, what we see for Apple's strong growth, 260 billion in 2019, 383 billion in September 2023. So we do note they have increased on a granular level their top line all the way to 2022 before a drop into 2023. Now, this could be some cause for concern, and we will take a look now, in fact, at their latest earning points to understand and identify where there may be some certain issues. Now, what we're going to draw your attention to is for their full annual report, so the 12 months ended column, we have September 23, and then here we have September 24. So what we really want to take a look at is the type of products where they are having issues, where that top line is reducing. And what we can see, in fact, nearly all of them, other than the services, have reduced on that top line. We see the iPhone category go from 205 billion to 200. We see the Mac go down from 40 billion to 29. And as we did mention, every single one of these have been reduced other than the services. Now, we understand that Apple did bring out the Vision Pro this year, so it will be interesting to see how that does affect their numbers over the coming quarters. But again, something to bear in mind, we are seeing a slowdown with Apple in terms of their products over the last year, and we do sense that in the next few quarters that will have a real impact on their numbers, hence why we could see the growth of this company start to slow down and impact that share price return. Now, when we take a look by actual reportable segment, the Americas, Europe, Greater China, Japan, and the rest of Asia Pacific, we see the numbers decrease for every single one other than the rest of Asia Pacific, where it did pick up very slightly. So it's not just issues with the products, we can see in terms of the different countries and regions that are selling these products, we are seeing this on a very, very large basis. So again, something to consider, but remember, when we do look at that valuation and we look at our different growth rates and expectations, as well as margin of safety, these are all part of the puzzle to consider. Quick health check then, total cash versus total debt. We see their cash, very large position, 100.5 billion in 2019, decreased to around 73 billion. So they do have a very large cash position, and even at that 73 billion, which is around a 27% reduction, still looking very strong. And when we compare it to their total debt numerically and directionally, we see it pretty much hasn't moved from around 108 billion from 2019 to that latest quarterly report. So something just to consider there. We do see now, for maybe the first time in a while, that their total cash is sitting lower than that total debt. And again, we'll look at that net debt to EBITDA metric to incorporate that within our analysis. Now, in terms of insider buys and sells, we've looked at over the last 3 months. We're looking at both buys and sells. There are no buys, and with sells that we can see here, this was from the director, in fact, not too long ago, around a week ago, 29th of February. He sold 100,000 shares at around $181 for 18 million. One thing I would say, always take insider sales with a pinch of salt. They're not the massively bearish signal. Insider sell, whether it's personal or financial reasons. But again, interesting to note that that was that massive sale from Arthur, the director. Now, in terms of looking at the institutional ownership, 58.51%, we have 74 billion worth of sales by these institutions, but still nearly more than double, in fact nearly double the amount of buys over the same period. So over the last 12 months, we can see institutions are still very bullish on Apple. On top of that, in the latest quarter, we see a lot more buying, a lot more inflows, which is depicted by the green column versus the red here that we see with the outflows. Other than Q3 in 2023, where we see the opposite, in 2023 we have 3 quarters of more buying than selling than just that one there where we see the opposite. So overall, institutions are doing a lot of buying of Apple stock, but as always, do your own due diligence, never just copy what these institutions do. Now, looking at the dividend safety, we have a score of 99, very safe, no real surprises there. Market cap 2.77 trillion. They are a mega cap company. Now, in terms of the key metrics for the recessionary period, well, they didn't pay a dividend, so nothing to comment on there. However, they had plus 14% sales, which remember is above the average growth of the S&P during the 07-09 crash, which was negative 12. And they also had a near recession return, negative 50% versus the S&P's negative 55. 4.3% in May last year. Now, 2 reasons why this isn't something that I'm too keen on. Firstly, it is around that 4% that I advocate on the channel just to keep up in line with inflation. And we can see previously over the last few years, they were looking like single high digit figures. And now at 4.3%, around that inflation level is just too low, especially when we look at that payout ratio and we know they can pay a much higher rate. And they do have a lot of cash. In terms of dividend growth streak, well, 11 years of continually increasing those dividends. In terms of dividend yield theory, well, those are the new. It essentially states the company is undervalued when the current yield sits above the 5-year average. So we have a sign here of reasonable valuation / slight overvaluation. However, on the forward PE, 26.3 is bang on the 5-year rolling average. So on this occasion, we do see reasonable valuation. Just bear in mind, though, we're not looking at any of these models in isolation, and we will conclude towards the end. Information technology, well, 27, so slightly higher than Apple's 26.2. As always, we do focus on that free cash flow payout just due to the fact that the earnings data is susceptible to manipulation by management through accounting. My personal blanket rule, below 60%. The reason for this, it gives me faith that management are able to offer double-digit dividend increases that we want to see. And what we can see over the longer term, that payout has started to decrease. 15% in 2023, 14% in 2024 expected, which is why I was saying I was really hoping to see last year a nice double-digit dividend increase. Hopefully this May we will see that. Well, free cash flow per share looking very strong. It has more than 3 times over the last 10 years. $2.05 in 2014, $6.33 in 2023, expected to go even higher in 2024. So lots to love. They are still increasing their free cash flow, which is often overlooked by analysts when they are looking at Apple. So again, that is a very key positive for this company. Sales growth, now this is what I was touching upon. For a company that is Apple, a huge brand, a huge moat, you would be expecting that top line to continue be increasing at a bare minimum at that steady moderate growth rate that we look for of 3 to 7%. What we can see though over the more recent period, negative 3% not looking great, 8% the year before looking very good, 33% excellent in 2021, so it is pretty inconsistent. So what I would say is it really does depend on how strongly this Vision Pro does get into their numbers, whether or not they have sold a lot of this product, and whether or not the new iPhone that is being speculated to have a lot of AI features does really drive their top line growth forward even more. Shares outstanding, again as always, we love it when companies do share buybacks, returning that excess cash. They have done a lot of share buybacks, reducing their count from 24.5 billion to 15.7, so that is nice to note. And we can see, for those that like to see numerically, the top line going from 183 billion to 383 in 2023. ROIC, one of my 7 golden dividend metrics. I want to see 10% or more. This will give me faith that management are able to effectively allocate their capital. And what we can see here is not only over the last few years has it been very strong in the 60s, but in 2014 the number has just been going up, so looking very, very strong. I am liking this figure as a company to invest in very, very well. Operating margin, pretty consistent on both margin and free cash flow, above the minimums that we look for. 30% on the operating side, looking strong. 26 on the free cash flow, again, very, very well. This is a very nice free cash flow machine and has been for quite some time. Now, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, correlates to the dividend safety as well as the balance sheet strength. What we're looking for here is these are the numbers it would take the company to pay off all of their debt net of cash on hand. 0.44, well below the 3 we're looking for, expected to go even lower in 2024. No real worries here on both their balance sheet strength as well as that dividend safety. Now, before we jump into the valuation, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any of the other articles we have produced, all completely free, just click on that pinned comment below. Okay, let's get into the valuation, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So we have the first model, we have the multiples valuation model, companies in a similar sector and size in the Mag 7 as we analysed earlier. We have their average P, the EPS, to get us our intrinsic value of $230. So we have our first sign of undervaluation. Just bear in mind though, we're not looking at any of these models in isolation. We then have the dividend discount model with the dividends over the last few years. Average growth rate 5.64%. Now on this channel I tend to be very conservative. However, for Apple I am expecting them to start to ramp up these increases much higher, so I have gone for 7.25 as an estimation. We get the intrinsic value of $137, so we have our first sign of overvaluation. Now the discounted cash flow model, we've got here the free cash flows year on year. We have the average growth rate at 9.9%. Forward looking, I've gone for 10%. With that and the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, we get a sign of undervaluation and an intrinsic value of $206. So this is what we'll be using to take forward to the intrinsic value calculator. However, what we want to show here is the different values that we would be attainable depending on the different growth rates. So we've gone for a low growth rate on what we believe at 10%. That would give us the value of 206 that we can see here, giving upside of 18%. Now, if we moved on to what we would say is a medium at 12%, again, this really does depend on your expectations. You'd get a share price intrinsic value of $237 based on the discounted cash flow model. And as we can see, that would be 36% upside. If you'd be looking for higher, or what we would consider to be high at 14%, you'd get an intrinsic value for Apple at $273, and that would be 57% upside. Again, bear in mind, This is assuming that you see 14% increase to their free cash flow year on year for at least the next 10 years and beyond. These will have different numbers, different merits behind why exactly, and this all comes down to that investor approach, what you're looking for in terms of your expectations, your risk profile, and if you truly believe with Apple, the Vision Pro, and the other products they are coming out, they can obtain these numbers. Now, let's go to the 10%, which is what we have used in today's episode. This gives us an intrinsic value for Apple sitting at $191. As always, you can click on that pinned comment below to grab a copy of the valuation model to get to the essential intrinsic value of companies in your own portfolio, those on your watch list, or even if you want to run through Apple based on your own metrics, that will allow you to do so. So we typically use a margin of safety of 10%, and we use that if we believe it meets the 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, then Apple is essentially a buy with a 10% margin of safety at $172, not too far off the current trading price, and who knows, maybe today it will hit that price. If you are looking for a little bit more at 15%, you would be looking to buy it around $162. But right now, based on the estimates and judgments in today's episode, we see a 10% margin of safety. In terms of Wall Street and what they expect, well, they see upside of 18% to the current trading price, a price target of $205, and they see this as a very strong buy now. As always, though, I'm keen to hear your thoughts, whether or not you see now is a great chance to buy the dip on Apple. This could continue to be a very strong company over the next 10-20 years, or perhaps maybe you see other companies taking their spot. Interested to hear your thoughts. As always, let me know, and if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are notified of these episodes, and as always, I'll see you on the next one.